Hello, traders. Have you ever wished that you had x-ray vision, that you could see through the charts exactly where those buy orders and sell orders are setting? We all wish that. Supply and demand is your answer. Let me explain. Now, supply and demand is the single most misunderstood concept in the stock market. You see, most traders think it's just about drawing lines on a chart and waiting for price to hit them. But if you treat these zones as just lines, you will get run over by the institutions. Context is king. And if you don't understand the behavioral psychology behind the order flow, you are truly trading blind. Today, we're going to dismantle the three biggest lies you've been told about supply and demand. We're moving beyond the basic buy support and sell resistance mentality that keeps retail traders like you and me trapped. You see, I want to know who is controlling the market at these levels. I want to understand the aggression behind the move. We're going to look at why order flow matters more than the drawing tool, why specific time frames invalidate your zones, and why confirmation is not optional for me. That is when I'm looking to enter. Only when the myths are stripped away and the real market structure is revealed. The first lie is that supply and demand is simply a graphical exercise. You see traders drawing boxes around every single pivot on the chart, cluttering their screen until price has nowhere to move. But supply and demand is not geometry, friends. It is psychology. When I look at a chart, I'm not looking for a line, I'm looking for a footprint. You see, supply and demand zones are created by an imbalance, a massive disagreement between buyers and sellers where one side completely overwhelmed the other. I want you to think about what is happening behind the candles. These zones represent unfilled orders from large institutions. When a hedge fund or a bank needs to fill a position worth millions of dollars, they cannot do it all at once without destroying the price. They leave evidence behind. This misconception here is treating the zone as a brick wall. It is not. It is a pocket of liquidity where individuals' desires and goals collide. If you see a zone, you need to ask yourself, what was the emotion here? Was it panic selling? Was it aggressive institutional buying? If price drifted away from a level slowly, that is not a demand zone that I care about. That shows me that there was no urgency, no aggression. But if price exploded away from a zone, leaving behind large imbalance candles, that is when I'm interested. That tells me the institutions are active there. They have unfinished business. So stop drawing lines at every swing low or swing high you see. I want to see struggle. I want to see the victory of one side over the other. If you cannot identify the behavioral psychology, the panic or the greed that created the zone, then that zone on your chart is probably useless. Myth number two is this, that all zones are created equal, or that you could use a zone created on a 5 minute chart for a swing trade that you're trading off of a daily chart. This is not the way we trade supply and demand. So let's debunk the second lie. The belief that all zones carry equal weight, that a zone that you might have found on a 5 minute chart you could use to swing trade a daily chart. No, that is the fastest way to blow up your account. You cannot trade a 5 minute supply zone in the face of a massive daily uptrend and expect it to hold as resistance. Now, context is king when assessing the strength of a zone. You see, I want to know that on the higher time frame charts like the daily or weekly, we're aligned with the dominant trend. Many new traders might find a pristine looking supply zone on a 15-minute chart, and they get all excited thinking, oh, look, this is where I'm going to short the market. I'm going to buy puts dated out to next week or next month. And it looks absolutely perfect on that 15-minute chart. But they're ignoring the fact that the daily chart is in a bullish trend. So, what do? They short that 15-minute zone and then they get crushed. Why? Because the higher time frame momentum will always steamroll the lower time frame structure. That's why it's important. If you're going to swing trade, you need to be swing trading from zones found on a daily or weekly chart. Now, if you're talking about day trading, hey, you can use zones off of a 15-minute chart, but context is king. Now let's talk about the difference between a fresh zone and a tested zone. Not all zones are equal, remember that. A zone that has been tested 3 or 4 times is not as strong as a zone that's never been tested. It is much weaker. You see, every time price visits a level, it consumes the liquidity sitting there. Think of it like a stack of wood. Every time you take a piece away, the stack gets smaller. Eventually, there's no orders left and price breaks through. You see, I want to find the zones that are fresh, the zones that are situated within the context of the larger trend. So if the S&P 500 is in a structural uptrend, I am primarily interested in demand zones to buy the dip. I'm ignoring most supply zones unless I'm day trading or unless they are major higher time frame reversal points. Do not treat a Tuesday afternoon intraday zone with the same respect you treat a multi-year support level. They are not the same. You must rank your zones based on the time frame and the departure. That's how you determine how long you intend to be in a trade. Is it a swing trade? Is it a day trade? Is it a scalp trade? Or is it a leap trade? How fast and how far did price move away from the zone? If the departure is weak, the zone is weak. Remember, not all zones are created equal. Know the time frame you want to trade that zone based on the amount of time to expiration. Know if a zone is fresh or tested, and know if a zone has a weak gradual move out of it or an explosive imbalance move out of it. That is the key. Now let's talk about myth number 3. The idea that you just blindly trade a zone, walk away, and don't worry about it. That sounds great, but reality is something different. Oh boy, the third lie. I can't tell you how many profits I gave up until I figured out a way to beat this. You see, there are times that if a zone is fresh, has had a beautiful imbalance move out of it, the market is in a trend, and I am confident in a setup, I will place a limit order right at a zone, but I'm not going full risk right there. You see, I want my foot in the door under special circumstances or special zones, but I'm not putting my complete risk out there on that first touch. I wait for confirmation before going full risk. Let me explain. Market conditions can change, right? You see, just because a zone existed yesterday does not mean it is going to work today. Like if news hits a wire or if the overall market sentiment is shifting, that demand zone that I marked might as well be tissue paper. That's where waiting for confirmation to be fully allocated in a trade is so important for me in trading supply and demand. I want to see price arrive at a zone and prove to me that buyers are still there if it's a demand zone, or sellers are still there if it's a supply zone. I want to see a reaction before I just blindly buy in that zone. So when price hits a daily demand zone, for instance, I'm not just buying blindly. I'm going to drop down to a smaller time frame chart and I want to see a change of character. Now, what does my confirmation process look like? I'm going to talk to you about it briefly. This confirmation is insurance for me. It tells me that the institutions are actually defending the level. Without confirmation, I'm essentially in a demand zone, possibly just catching a falling knife. And if you look at how price arrives at the zone, that's important as well. If price is crashing down with massive red candles showing extreme momentum, that is not the time to step in. You see, I want to see the momentum slow down. I want to see the exhaustion of the sellers before I commit my capital. My process is this. Number one, price hits a daily demand zone. Number two, I'm going to go down to a smaller time frame zone or smaller time frame chart like a 1 hour or a 30-minute chart. Then I'm looking for the change of character. In a demand zone, I'm looking for a higher low and a break above the body of that candle. In a supply zone, I'm looking for a lower high and a break below the body of that candle. When those conditions are met, that gives me my high probability entry. So remember, supply and demand is not just lines on a chart. It is the footprint of big money. It is understanding the narrative of the market. Context is king. Do not trade in isolation. Identify the aggression behind the zones. Align yourself with the higher time frame trend and always wait for the market to show its hand before you enter. That's how you move from gambling on lines to trading with precision, supply and demand zones. All right, do me a favor. Make sure you hit like on the video and you're subscribed to my channel. And if you're interested in learning more about supply and demand trading, the evolution in 2026, I invite you to join me and my trading partner, Trendy John, on March the 11th. We're going to do a free webinar all about how we are trading supply and demand in 2026. I would love to see you there. There will be a link in the description that you can sign up now, and it's free. So go ahead and sign up. I look forward to seeing all of you in the next video.